Understanding economic phases, a guide to market cycles. The economy works in cycles like a machine with predictable parts and sequences. We will break down the economy into 5 distinct phases, each with unique characteristics. Understanding these phases will give you a tremendous advantage. We'll explore the 5 key phases: initial recovery, early growth, late growth, slowdown, and recession. By understanding these cycles, you'll be equipped to anticipate market shifts and make informed financial decisions. So, let's dive in and unlock the secrets of economic cycles together. Initial recovery. The green shoots of growth. Imagine an economy emerging from a recession. Businesses have tightened their belts, and unemployment is high. The landscape looks bleak, with many storefronts shuttered and job seekers facing uncertainty. This is the initial recovery phase where the first signs of life appear. Just like the first green shoots in spring, the economy starts to show subtle signs of improvement. Governments and central banks often step in with stimulating policies, lowering interest rates, cutting taxes, and increasing public spending. These measures are designed to jumpstart economic activity and restore confidence. Confidence begins to return, businesses start to invest, and consumers open their wallets. Shopping malls see more foot traffic, and business deals start to flow once again. The stock market anticipates better days ahead, and stock prices start to climb. Investors, sensing the change, begin to pour money back into the market, driving up valuations. New businesses are formed, existing ones expand, and the economy begins its slow climb back to health. Construction sites buzz with activity, and office spaces start to fill up. Understanding this phase is essential for investors as it presents unique opportunities. By recognizing the early signs of recovery, they can position themselves to benefit from the economic upswing. Early growth, steady expansion, and rising confidence. As the economy moves from recovery to early growth, we see a shift to sustainable, healthy expansion. Businesses are hiring, consumers are spending, and the economic engine hums with activity. Governments and central banks start to wean the economy off stimulus measures, gradually tightening policies to prevent overheating. Confidence continues to rise, fueling further economic expansion. The stock market, buoyed by strong corporate earnings and positive economic data, generally continues its upward trajectory. This is a period of steady, sustainable growth, an ideal time for businesses to invest and expand. Chapter 3. Late growth, prosperity, and the seeds of excess. The late growth phase is where the economic party really gets going. Unemployment is low, and businesses enjoy record profits. Companies expand rapidly, and consumer spending is at an all-time high, fueling further growth. Confidence is at its peak, but inflation starts to rear its ugly head. Prices for goods and services begin to rise, eroding purchasing power and creating concerns among policymakers. Governments and central banks step in with more restrictive policies, raising interest rates to prevent overheating. These measures aim to cool down the economy and keep inflation in check. Despite these efforts, confidence remains high, but cracks begin to appear in the financial markets. Investors start to worry about the sustainability of the growth, leading to increased market volatility. Short-term interest rates continue to rise, and the stock market becomes more volatile. The once steady climb of stock prices now shows signs of instability, causing unease among investors. This is a time for caution, as the good times may not last forever. Investors need to be vigilant and consider diversifying their portfolios to mitigate potential risks. Understanding the dynamics of the late growth phase is crucial for investors to navigate market volatility. By staying informed and prepared, they can better manage their investments and protect their financial future. Chapter 4. Slowdown. The hangover begins. The pace of economic growth slows, inflation continues to rise, and cracks in the foundation widen. Businesses adjust inventories, and consumers pull back on spending. Governments and central banks face a delicate balancing act, trying to control inflation without crashing the economy. Confidence begins to wane, and businesses become more cautious. The stock market reflects growing pessimism, with declining stock prices and elevated volatility. This is a time for prudence and careful navigation. The decisions made during this phase can significantly impact the severity of the impending downturn. Chapter 5. Recession, the pain of contraction. The recession phase is the inevitable consequence of the excesses of the previous phases. It is a period marked by a significant decline in economic activity across the board. Economic activity contracts, businesses close, unemployment rises, and fear grips the markets. The impact is felt by everyone from large corporations to small businesses and individual workers. Inflation typically begins to subside, and governments and central banks reverse course on policies to stimulate growth. They introduce measures such as stimulus packages and interest rate cuts to revive the economy. Confidence hits rock bottom, and the financial markets experience significant declines. Investors become wary, and the stock market often sees its most severe drops. Short-term interest rates fall sharply as central banks encourage borrowing and spending. This is done in an attempt to inject liquidity into the market and spur economic activity. The stock market often experiences its most significant declines during this phase. Panic selling becomes common, and market volatility reaches new heights. Understanding this phase is crucial for investors to preserve capital and position themselves for the next recovery. By recognizing the signs and preparing accordingly, they can mitigate losses and take advantage of future opportunities. Outro: navigating the economic cycle. A roadmap for success. The economy moves in cycles, periods of growth followed by periods of contraction. Understanding these phases and the accompanying policy responses, market conditions, and shifts in confidence is essential. Think of this table as your economic compass guiding you through the ups and downs of the market cycle. By recognizing the signs, you'll be better equipped to anticipate changes, mitigate risks, and capitalize on opportunities. While the economy is complex, it's not a mystery. By understanding the patterns and cycles, we can make more informed decisions and achieve our financial goals. Welcome to our comprehensive guide on navigating the economic cycle. Before we dive into the intricate details, let's take a moment to outline the roadmap of our journey. This video will cover 1. Market cycles overview. 1. The green shoots of growth. 1. Steady expansion and rising confidence. 1. Prosperity and the seeds of excess. 5. The hangover begins. 1. The pain of contraction. 1. A roadmap for success. Understanding these key phases will empower you to anticipate market shifts, mitigate risks, and seize opportunities. So let's get started on this enlightening journey through the economic landscape.